If you observe carefully what's happening with idle money right now, you'll notice something that should concern every person over 40 with retirement savings. The very concept of safe money sitting in savings accounts, money market funds, or short-term treasuries has become a mathematical guarantee of wealth destruction, not a possibility, not a theory, a mathematical certainty. And if you're holding significant cash waiting for the right time to invest, every month you wait, you're making a decision that will cost you and your family dearly over the next decade. This isn't a prediction. It's a logical consequence of forces already in motion. I've been analyzing financial markets and economic systems for over 40 years, and what I'm sharing with you today isn't speculation. It's pattern recognition. When you understand incentives, you understand behavior. And right now, the incentives of central banks, governments, and major financial institutions are all aligned in one direction, a direction that makes holding idle cash the most expensive decision you can make. Consider these specific data points. The Federal Reserve's balance sheet stands at $7.4 trillion, up from $4.2 trillion just 5 years ago. The U.S. national debt has surpassed $36 trillion, with annual deficits averaging $1.8 trillion. Real interest rates, when you subtract actual inflation from nominal rates, remain negative in most developed economies. These aren't abstract numbers. They represent a fundamental shift in how wealth preservation works. The mechanism destroying idle money is elegantly simple, almost mechanical in its operation. Think of the monetary system as a restaurant where the owner keeps adding tables and chairs, but the kitchen produces the same amount of food. Each dollar you hold is a chair at that restaurant. The more chairs get added, through money printing, quantitative easing, deficit spending, the smaller the portion of food each chair receives. Your dollar doesn't disappear. It just commands less and less of the real goods and services in the economy. The average American with $100,000 in a savings account earning 4.5% interest might feel prudent and safe. But if actual inflation runs at 6 to 7% when you include food, energy, housing, and healthcare costs that real people experience, that person is losing $2,500 to $3,500 in purchasing power every single year. Over 10 years, assuming these trends continue, that $100,000 becomes equivalent to roughly $60,000 in today's purchasing power. The money is there. The zeros are there. But what it can buy has been systematically reduced. Currently, 4 major pressures are accelerating this dynamic. First, government debt service costs have reached $892 billion annually and rising, creating irresistible pressure to keep rates from rising too high, while simultaneously devaluing the debt through inflation. Second, the demographic shift means 73 million baby boomers are transitioning from productive contributors to Social Security and Medicare recipients, creating a $157 trillion unfunded liability that can only be managed through currency debasement. Third, geopolitical fragmentation is forcing nations to choose between allies, reducing the efficiency of global trade and increasing costs across supply chains. Fourth, the transition from a unipolar to multipolar financial system means the dollar's privileged position is eroding, which historically has meant importing inflation that was previously exported to other nations. History is an excellent teacher if you're willing to learn its lessons. In 1971, President Nixon closed the gold window, ending dollar convertibility to gold. At that moment, gold was $35 per ounce. Today, it's over $2,650 per ounce. That's not gold going up. That's the dollar going down by 98.7% against the one asset that governments cannot print. The people who held cash from 1971 to 1980 watched their purchasing power evaporate. $1 in 1971 is worth about 18 cents today when measured against the consumer price index, and even less when measured against actual cost of living for middle-class families. The pattern repeated in the 1970s when inflation averaged 7.4% annually for the entire decade. Someone with $100,000 in cash in 1970 had the equivalent of $41,000 by 1980 in real terms. They still had $100,000 in nominal terms, of course. The bank statement looked fine. But rents had tripled, gas prices had quadrupled, and a basket of groceries cost 2.5 times what it did a decade earlier. The 2008 financial crisis provides another instructive example. When the Federal Reserve launched its first quantitative easing program, buying $1.35 trillion in mortgage-backed securities, conventional wisdom said this would cause immediate hyperinflation. It didn't, because the velocity of money collapsed. But here's what did happen. Asset prices inflated dramatically while cash savers got crushed. From March 2009 to March 2019, the S&P 500 returned 322%. Real estate in major metro areas appreciated 80, 120%, and quality corporate bonds returned 65%. Meanwhile, money market funds and savings accounts returned essentially zero after inflation. A retiree with $500,000 in safe cash in 2009 still had roughly $500,000 in 2019, but their purchasing power had declined by approximately 18%, and they missed out on $1.6 million in gains they would have achieved with a balanced portfolio. That's not a small difference. That's the difference between a comfortable retirement and one filled with financial stress. Even more extreme, look at the Weimar Germany example from the early 1920s. While America won't experience that level of hyperinflation, the principle remains instructive. In 1918, a German with 100,000 marks in savings was wealthy. By 1923, that same 100,000 marks couldn't buy a loaf of bread. The people who survived with their wealth intact weren't those holding currency. They were those who held real assets: farmland, businesses, buildings, precious metals, productive equipment. The pattern is consistent across history. When governments face unsustainable debt and unfunded promises, they choose inflation over default every single time, because inflation is a hidden tax that most people don't understand until it's too late. To understand what's happening to idle money, you need to understand three fundamental principles. The first principle is currency debasement mechanics. Imagine a seesaw with debt on one side and currency value on the other. As debt increases, there are only three ways to rebalance: economic growth, default, or debasement. Economic growth at rates sufficient to outpace debt growth is mathematically impossible given current demographics and productivity trends. Default destroys the political careers of everyone involved and triggers financial system chaos. That leaves debasement, slowly, quietly reducing what each unit of currency can purchase. This is happening right now. The M2 money supply has grown from $8.5 trillion in 2010 to over $21 trillion today. That's a 147% increase in the money supply, while economic output has grown only 64% in real terms. The gap between those two numbers is the debasement, and it accelerates during crisis periods when governments face difficult choices. The second principle is the asymmetry of inflation impact. Inflation doesn't affect all assets equally. It savages cash and fixed income instruments that can't adjust their nominal returns. It harms wage earners whose incomes lag behind price increases, but it benefits owners of real assets whose values and income streams increase with inflation. If you own an apartment building and rents increase 6% annually while your fixed-rate mortgage payment stays constant, inflation is your friend. If you own quality stocks and companies that can pass costs along to customers, inflation might even boost your returns. But if you're holding cash, you have no defense mechanism. You simply lose purchasing power with mathematical precision. This creates a widening gap between asset owners and cash holders that compounds over decades. The third principle is institutional behavior patterns. Central banks, pension funds, sovereign wealth funds, and family offices aren't holding large percentages of cash. They're diversified into real assets, stocks, bonds, real estate, commodities, and alternatives. When you understand incentives, you understand behavior. These institutions have armies of analysts, access to the best data, and fiduciary responsibilities to preserve and grow wealth. They're not holding 40% cash. They're holding 2 to 5% cash for liquidity purposes and deploying the rest systematically. The Bank of Japan holds massive quantities of stocks. Central banks worldwide have been accumulating gold at the fastest pace in decades, adding over 1,000 tons annually. Norway's sovereign wealth fund owns 1.5% of all global stocks. These aren't accidents. These are deliberate strategies based on understanding these principles. Let me tell you a story that illustrates this perfectly. In 2010, two families lived in the same suburban neighborhood. The Martinez family had $800,000 from selling a business. Concerned about market valuability after the 2008 crash, they kept $600,000 in money market funds and CDs, allocating just $200,000 to stocks. They felt safe, prudent, and smart. The Chen family had $850,000 from a combination of inheritance and savings. They kept $50,000 in emergency cash and allocated the remaining $800,000 across a diversified portfolio: 40% stocks, 25% real estate investment trusts, 20% international stocks, 10% commodities, and 5% precious metals. They rebalanced annually and never tried to time the market. By 2024, here's what happened. The Martinez family's $600,000 in safe money had grown to approximately $680,000 through interest, but inflation had reduced its purchasing power to roughly $510,000 in 2010 dollars. Their $200,000 stock allocation had grown to $720,000. Total portfolio, $1.4 million nominal, about $1.23 million in real terms. A 44% real return over 14 years, or about 2.7% annually. Not terrible, but underwhelming given the market conditions. The Chen family's $800,000 diversified portfolio had grown to $2.65 million nominal, about $231 million in real purchasing power. A 172% real return over 14 years, or about 7.4% annually. The difference? $1.08 million in real wealth. That's not made up. That's the typical pattern when you compare concentrated cash positions to properly diversified portfolios over inflationary periods. The Martinez family, now in their late 60s, faces difficult decisions. Their retirement lifestyle must be more modest than planned. International travel is limited. Helping grandchildren with college seems financially unwise. The Chen family, same age, has the retirement they envisioned: comfortable international travel, ability to support family members, and sufficient wealth to handle medical emergencies or long-term care needs without stress. Two families, similar starting points, radically different outcomes based entirely on how they viewed idle cash. Now let's translate this to what really matters, how this affects you personally. If you're 55 years old with $500,000 in retirement savings and you're holding $300,000 of that in cash or cash equivalents because you're waiting for a correction, or you don't trust the market, or you're being cautious, here's what the mathematics tell us will likely happen. Assuming 5% inflation annually, conservative given current fiscal trajectories, that $300,000 will have the purchasing power of approximately $184,000 in 10 years when you're 65. You will have lost $116,000 in real wealth by doing nothing, not by making a bad investment, not by getting unlucky, simply by holding what feels like the safe position. Meanwhile, that same $300,000 deployed into a balanced portfolio earning 8% annually would grow to $648,000 nominally, worth about $398,000 in today's purchasing power. The difference between the cash position and the invested position is $214,000 in real wealth over just 1 decade. For most middle-class families, that's the difference between financial independence and financial anxiety in retirement. It's the difference between maintaining your lifestyle and downsizing everything. It's the difference between being a financial resource for your children and being a potential burden to them. Consider the daily impact in concrete terms. With $398,000 in purchasing power available at retirement, you can withdraw 4% annually, $15,920, plus adjust for inflation each year while maintaining your principal. That provides meaningful supplemental income alongside Social Security. You can afford healthcare costs that run $15,000, $25,000 annually without depleting your nest egg. Travel becomes manageable. A $5,000 trip annually doesn't threaten your financial security. You can help a grandchild with college, contributing $10,000 without second-guessing the decision. Compare that to the reality with $184,000 in purchasing power. A 4% withdrawal provides just $7,360 annually before inflation adjustments. Healthcare costs consume a crushing percentage of your portfolio. That same $5,000 vacation now represents a serious financial decision that might need to be skipped. Helping family becomes impossible without jeopardizing your own security. Home repairs that inevitably arise, a new roof at $12,000, an HVAC replacement at $8,000, become genuine crises rather than manageable expenses. The stress compounds year after year. This isn't theoretical. This is the lived reality of millions of Americans who held too much cash during inflationary periods, who prioritized the false comfort of nominal account balances over the hard reality of declining purchasing power. Based on these principles, here are practical guidelines for someone in your position. If you're between 40 and 65 with accumulated retirement savings, your allocation might look like this: 35% in diversified global stocks through low-cost index funds, providing growth and inflation protection. 25% in real estate exposure through REITs or direct property ownership, which adjusts with inflation and provides income. 15% in high-quality corporate bonds with varying maturities, providing stability and income. 10% in commodities and commodity-related stocks, which historically perform well during inflation. 10% in precious metals like gold and silver as monetary insurance. And just 5% in cash for true emergencies and opportunities. What to avoid is equally important. Avoid holding more than 10-15% in cash unless you have a specific time-bound purpose for it, like a home purchase within 6 months. Avoid loading up on long-term bonds when real rates are negative. Avoid keeping retirement money in traditional savings accounts or money market funds for extended periods. Avoid the psychological trap of waiting for the perfect entry point while inflation erodes your purchasing power daily. Implementation should be gradual and methodical. Don't rush to deploy everything in one day or even 1 week. Over 6 to 12 months, systematically move excess cash into your target allocation using dollar cost averaging. For example, if you have $300,000 to deploy, consider moving $25,000 per month for 12 months or $50,000 per month for 6 months. This reduces timing risk while still getting capital deployed before inflation does more damage. Set up automatic monthly transfers so emotion doesn't interfere with your plan. Review your progress quarterly, but resist the urge to constantly tinker with allocations based on short-term market movements. Prepare yourself psychologically for volatility because it will come. Markets fluctuate. Real assets experience price swings. A 10% correction in stocks happens almost every year on average. A 20% correction happens every few years. This is normal and healthy market behavior, the price you pay for long-term returns that outpace inflation. What's not healthy is watching your cash lose 5 to 7% of its purchasing power annually with absolute certainty while avoiding assets that might experience temporary 10-15% drawdowns but provide long-term protection and growth. The psychological key is understanding that temporary volatility in assets that trend upward over time is far less damaging than permanent erosion of purchasing power in cash. Common pitfalls to avoid include paralysis from information overload, which leads to perpetual analysis while taking no action. Another pitfall is overconcentration in whatever performed best recently, ignoring diversification principles. A third is trying to time everything perfectly, waiting for confirmation that you found the absolute bottom, which virtually never comes with clarity. The fourth is panic selling during normal market corrections, locking in losses and then sitting in cash again, repeating the destructive cycle. Nothing I've shared constitutes specific financial advice for your individual circumstances. Every person has different needs, risk tolerances, time horizons, and goals. Tax considerations vary by individual. The appropriate allocation for a 45-year-old with steady income differs from a 70-year-old living on fixed retirement distributions. Consult qualified financial professionals who understand your complete situation before making any investment decisions. But understand the broader principle at work. The financial system has changed fundamentally. The rules that governed wealth preservation from 1950 to 2000, where you could safely hold cash in banks and bonds and maintain purchasing power, no longer apply. We're in a different regime, one characterized by structural debt, demographic pressures, geopolitical fragmentation, and currency debasement. The choice is yours. But remember this: central banks aren't holding 40% cash. Pension funds aren't holding 40% cash. Sovereign wealth funds aren't holding 40% cash. The Bank of Japan, the Norwegian Government Pension Fund, Singapore's GIC, the Yale Endowment, they're all heavily allocated to real assets for specific logical reasons. They understand that in a world of expanding money supply and constrained real resources, holding currency is holding a depreciating claim on real wealth. Gold purchases by central banks have reached levels not seen in decades, with net purchases of 1,136 tons in 2022 alone. That's institutions with perfect information about monetary policy choosing to own real assets instead of currency. That should tell you something important about how they view the future of cash. That's why this channel exists, to help you see the signals that major institutions see before they become obvious to everyone else. We observe the behavior of informed players, analyze the mechanical forces at work in the system, and share conclusions drawn from historical patterns and current data. If this analysis makes logical sense to you, if you understand the mathematics of currency debasement and the asymmetric impact of inflation on different asset types, I encourage you to subscribe and share this with people you care about. Financial education is the most valuable gift you can give your family and friends because it compounds across generations. The decisions you make in 2026 regarding idle cash will determine whether you and your family thrive or merely survive over the next decade. Make them wisely, based on principles and patterns, not on emotions or conventional wisdom that no longer applies to our current reality. The era where idle money was safe money has ended. Adapt to that reality or pay the price of ignoring it.